fund that was the best performer for the past 10 years. While investors read in the fine print of an advertisement or prospectus that past performance is not indicative of future results, they still prefer to ignore this advice. As individuals, we always tend to look backwards when making our decision making, and that is the wrong way to think. We usually buy the fund that was the best performer for the past 3, 5, or 10 years. The best example there was Frank Mersch when he was at Altamira. In the early 1990s, was making 20% a year compound annual gains. But remember, the size of his fund was very small. As he started to show those banner returns and investor money piled in, then the fund grew to over $1 billion. And instead of being able to buy and sell the stocks that he wanted to own, he had to trade like the market and therefore started getting investor returns like the market. The problem is that with those kinds of returns, if he wanted to do better, he had to take on more risk. And he eventually got caught by the OSC and the BC Securities Commission for front-running gold stocks and was suspended for 2 years.
While at Wharton, I studied under Harry Markowitz. He taught me, he was the father of portfolio theory, and he won a Nobel Prize in 1991 in economics. And while he was a terrific teacher, I'm not quite sure what I learned. I also studied under Marshall Bloom. He, along with Irwin Friend and Gene Crockett, wrote that dart throwing. And George and I chatted over lunch. The markets are imperfect, contrary to what they taught me in business school. Darts ain't going to do it. It's hardcore fundamental analysis. So, the bottom line is, if I had to offer you any words of advice, study hard here. Learn all about the theories and formulas that you pick up in school. But it's clearly the school of hard knocks. You've got to learn, and the only way you learn is by making mistakes, and you learn from those mistakes.
It goes public in 1919, $40 a share. 1 year later, it's selling for $19, gone down 50% in 1 year. Now you might think that's some kind of disaster, and you might think that sugar prices increased and the bottlers were rebellious and a whole bunch of things. You could always find a few reasons why that wasn't the ideal moment to buy it. Years later, you'd have seen the Great Depression, and you'd have seen World War II, and you'd seen sugar rationing, and you'd seen thermonuclear weapons, and the whole thing. There's always a reason. But in the end, if you'd bought one share for $40 and reinvested the dividends, it'd be worth about $5 million now. And that factor so overrides anything else. I mean, if you're right about the business, you'll make a lot of money. And the timing part of it is a very tricky thing. So I don't worry about any given event if I've got a wonderful business, what it does to next year.
That goes along with it is margin of safety, which is simply if you think something is worth between 800 million and 1.2 billion, let's say you can come up with a range of intrinsic value. It's never a precise number because anything involving predicting the future is always there's some degree of uncertainty. So the question, if you think something is worth between 800 million and 1.2 billion, would you pay $1 billion for it? And the answer is of course not. You have no margin of safety. You're paying sort of in the middle of the range of intrinsic value, and that doesn't make any sense because if you're wrong about your predictions about the future, you're going to get killed. What you want to do is if you think something is worth a range, pick the midpoint of that range and then try and buy it for, call it half of that price. So buy a company when it has a market capitalization in the stock market of 500 million when you've calculated that it's worth somewhere between 800 million and 1.2 billion. That way, if you have a margin of safety, if you're wrong, you're likely not to have a permanent loss of capital. So the concept of margin of safety applies in a lot of different things, not just investing. For example, if you were building a bridge and you estimate that trucks going over it might, at its maximum point, weigh 10 tons, would you build a bridge that would collapse under 11 tons worth of weight? Of course not. You would engineer in a margin of safety such that the bridge would hold 30 tons worth of weight if you anticipated that the maximum amount of weight that would ever be on it might be 10 tons, right? So same concept applies in a lot of different areas. So The most important thing I want to leave you with is value investing does not mean buying crummy businesses because they trade at some low multiple of book value or earnings or something like that. The most successful value investors, in fact, strive for and own very good businesses, but look to buy them when they've fallen out of favor.
Studies have found that going against the majority is incredibly hard. People will generally suppress their own opinions instead. Dr. Gregory Burns is a neuroeconomist at Emory University. In one of his experiments, volunteers were shown three-dimensional blocks in various configurations. They were asked, are the blocks identical? When the volunteers were alone, they almost always gave the correct answer. The blocks are the same. But when they were put with people coached to give the wrong answer, the volunteers changed their minds. They said the blocks were different. Burns says brain scans revealed why. The desire to please the group was so strong, it actually altered the way the volunteers saw the blocks.
There is, as far as our brains go, kind of no reality. The reality is what we construct in our mind, and that's influenced by other people.
So, studies of the brain confirm that people are very sensitive to peer pressure. But some people are able to withstand that pressure. They're not afraid to go against the crowd. They're called iconoclasts.
Hi, how are you?
Among investors, Warren Buffett is an iconoclast. He often goes against conventional wisdom on Wall Street. Peterson says being an iconoclast may seem risky, but it's often profitable.
In the financial markets of today, if you see a danger, you can probably bet that everybody else has seen that danger as well. And in fact, it turns out it's probably best to buy at that time when you see the danger. It's very ironic, but financial markets are completely counterintuitive.
So herding may be good for cows, but if you're an investor, even a bullish one, it's one form of animal behavior you may want to avoid.
I think one of the things that most people don't realize is that Sir John was a big fan of basically changing your investment approach all the time. You know, we maintained a list of stock selection methods at Templeton, and as the director of research, I was sort of responsible for monitoring that. And he always wanted to have 12 new ways of looking at stocks. And most people think that there's a Templeton, formula.
There have been books written about it. Right.
And to a certain extent, there is a bit of a formula. And when you're selling an institutional product, you have to have some consistency in your products all over the world. And we used to do a lot of work relative to future earnings and trying to discount future earnings to today's stock price and looking at dividend streams over that time period. But basically, Sir John said, if you're doing the same thing you did 10 years ago, it's not going to work. And so I would say we're constantly trying to improve on what we do. And I also would say that the market's always offering you something. And I think this is something that Sir John was very good at. Sir John's genius is in his simplicity, really. And he was always very good at identifying what was cheap in the market. So at some point in time, growth stocks might be cheap. Other times, value stocks might be cheap. Today, what's cheap in the market is free cash flow. Free cash flow is abnormally high. What he tried to teach us was find what's cheap in the market. What is the market offering you? And then try to understand, well, why is it cheap? What is the rationale behind those prices being so low?
You probably think of yourself, when it comes to investing, as being a totally rational being. Well, here's a news flash. You're probably not. And with me to talk about how sometimes when it comes to investing we are our own worst enemy is Alan Roth, a certified financial planner and a columnist for MoneyWatch.com. Alan, thanks for joining us.
Thanks, Eric. Thrilled to be here.
I think I'm a totally rational investor because right now all I want to do is get out of the stock market. What's irrational about that?
Well, it's certainly a feeling that I have right now, and it would make the pain stop because I've seen my own portfolio fall. But is it rational now that the market has a half-off sale?
What if the sale is going to 75%? That's what it looks like.
My crystal ball is broken. It's never worked, so I really don't know what the market's going to do. But I do know that studies show that we consistently get into the market in years like 2006 and 2007, when U.S. stocks doubled and international stocks tripled, and now that the market is plummeting, more money is pouring out of stock mutual funds than ever before. It doesn't work. We time the market really poorly as humans.
The academic definition of these is so off from the truth that the way we think about it is, if you really, academics think securities are basically efficiently priced, and we think that it's easy to find things that are not efficiently priced, and there are often reasons for that: bad management, or complicated structures, or fees and expenses. But if you could find, let's just say, a closed-end fund that has $20 worth of value trading at 10, that's, you might find such a thing today, that would be interesting. Now, if that drops to 5 and the NAV stays the same, it drops to 5 because a Russian bank that owned a lot goes bankrupt and has to sell tomorrow, academics would say that's an efficient price, and they would say it's become riskier because that stock moved 50% in one day, so the beta's higher. And we would say, wait a minute, you have half as much that you can lose. It's gone from 10 to 5. It can only go to 0, so you can only lose half as much. And now you can go from 5 to, instead of going from 10 to 20, you can go from 5 to 20. You can make twice as much. So we would say that they interact because the less risk, the more return. They're two sides of the exact same coin. But that's not what academics say. Academics say the riskier it is, the more return. But we'd say the less risky it is, the more return. So we're really talking at complete odds with each other. And, I have 26 years of experience. Warren Buffett has 50 years of experience saying I'm right and academics are wrong.
Later, but there are two ways to think about intrinsic value very simply. One is what would a rational cash-paying buyer pay to own this entire company or this entire apartment building or whatever it is that you're trying to value. And then a second way of thinking about it is using a discounted cash flow. What a rational buyer would pay for something is usually based on what the future free cash flow that asset will generate over its lifetime, discounted back at an appropriate rate to the present. So I'll come back to that, but there are a number of different ways to calculate intrinsic value. It's more art than science, but that's core principle number one. The second principle that goes along with it is margin of safety, which is simply if you think something is worth between 800 million and 1.2 billion, let's say you can come up with a range of intrinsic value. It's never a precise number because anything involving predicting the future is always there's some degree of uncertainty. So the question, if you think something is worth between 800 million and 1.2 billion, would you pay $1 billion for it? And the answer is of course not. You have no margin of safety. You're paying sort of in the middle of the range of intrinsic value, and that doesn't make any sense because if you're wrong about your predictions about the future, you're going to get killed. What you want to do is if you think something is worth a range, pick the midpoint of that range and then try and buy it for, call it half of that price. So buy a company when it has a market capitalization in the stock market of 500 million when you've calculated that it's worth somewhere between 800 million and 1.2 billion. That way, if you have a margin of safety, if you're wrong, you're likely not to have a permanent loss of capital. So the concept of margin of safety applies in a lot of different things, not just investing. For example, if you were building a bridge and you estimate that trucks going over it might, at its maximum point, weigh 10 tons, would you build a bridge that would collapse under 11 tons worth of weight? Of course not. You would engineer in a margin of safety such that the bridge would hold 30 tons worth of weight if you anticipated that the maximum amount of weight that would ever be on it might be 10 tons, right? So same concept applies in a lot of different areas. So the most important thing I want to leave you with is value investing does not mean buying crummy businesses because they trade at some low multiple of book value or earnings or something like that. Most successful value investors, in fact, strive for and own very good businesses, but look to buy them when they've fallen out of favor for some reason. So,
first of all, I agree with everything Chris has said, and I think you're right. But I think what's also...
That makes me feel much better.
but I think the key thing is that a lot of companies, their underlying earnings are growing at a rapid clip. And today, people don't factor in a bright future. People basically think the world is going to end or it's going to do nothing. And the tone is so gloomy. So, the irony is that people become momentum investors. When anything goes up, they chase it. When it goes down, they don't want to have anything to do with it. So we've had 10 years wandering in the wilderness in which stocks are cheap and also the world around us keeps getting better. And so I think that, Consuelo, if we look forward, stock returns will probably be pretty good, especially...
There's a couple of simple facts that people get wrong. First, cheap funds do better than expensive funds. No-load funds do better than load funds. But actually a provable fact is people that invest in load funds do better than people who invest in cheap funds, even though the funds themselves don't behave that way. And the reason is that the history of people who invest in load funds is that load creates a sort of a psychological prison for them, and they hold them for a really long time. The people that invest in passive funds and cheap no-load funds tend to in and out at all the wrong times, and they hold them for much shorter time periods and use them much more like trading vehicles. Very few people can do what you correctly prescribe, which is buy that cheap fund and hold it for a long time. They buy it, then they sell it at the wrong time, then they buy another different version of it at the wrong time, then they sell it at the wrong time. The average no-load mutual fund holding period is less than 18 months.
I mean, I think that periodically, of course, everybody decides value investing has had its day and it's never going to work again. The classic time that happened was in 1999. Value investors had a very bad 2008, many of them, and I think it's because they really forgot that it does take assets to make money. So they looked at the profits that, in some cases, financial institutions were making, and they said they're going to make those forever.
Right.
And they got caught in the downdraft because, of course, the financial markets were at the heart of the...
Well, I mean, let's start with a company that we both like, Nestle. Now, do I really think that Nestle is going to sell less product in 3 years than it sells today? Right? With all of the... Do I think Colgate will sell less toothpaste? Do I think Coca-Cola will sell fewer Cokes? I mean, the U.S. is 5% of the world's population. You know, the Venezuela is the 6th largest beer market in the world. Heineken makes more money in Nigeria than in the United States. So we have this view about, oh, what's happening in Europe, what's happening in the U.S., without going through and thinking about the business. If the three of us together owned all of Nestle, and we were looking at what was happening in Europe, what was happening in the U.S., I don't think for a moment we would be worried that our sales 5 years from now would be lower than they are today.
But aren't those still big markets for Nestle, for instance?
Yes, but they're...
And doesn't it impact them, let's say, for the next 3 or 4 years as we get through this problem in the developed world?
I think the question is, will these sorts of consumer staples, are people going to buy less of those? No, will people buy...
You're not eating.
I don't have a Bloomberg on my desk. I don't care.
You don't have a Bloomberg on your desk?
No.
Because you don't...
Mike makes enough.
What's on... Yes, I know. But what's on your desk then? A phone?
Giant piles of paper that are at risk of falling on me at any moment, and I have a computer and a phone.
Yeah. So tell us about your desk.
Half-filled water bottles.
Yeah. I mean, but you sit at a trading desk. I mean, when you're not meeting either clients or people that are going to give you some information that might be relevant to what decisions you have to make, you're sitting at a trading desk.
Thinking big thoughts.
Are you really? Are you? It's not so much because you are reacting to the volatility of every market that you're invested in. Because if you are a value investor, my assumption would that you're not looking to trade every moment.
We're not traders. There's a wonderful story. Right. Chris Brown at Tweedy Brown tells a story of how they were interviewing somebody to come and to come join their firm. And after the interview, he's walking the fellow to the elevator. And the fellow says, it's amazing here at Tweedy Brown. At most firms, you can tell from the atmosphere in the place whether the market's up or the market's down. At Tweedy Brown, you can't even tell if the market's open. And I think it's like that at our firm. We're making medium to long-term investments, 3 to 5 years or longer. And so we're not really that interested. The only reason we care about the gyrations is so we can buy something even cheaper.
I mean, investment is a pretty simple thing. Investment is owning businesses, or I would say, being an inveterate index fund person, owning all of American business, owning every company in America, letting capitalism do its work. Those companies will grow at probably around 7% a year. They'll pay you about a 2.5%, somewhat lower than history, but a 2.5% dividend yield. And that should, over time, bail you out of anything that happens because of the wild swings. I mean, if you visualize investment as growing in kind of a steady line, which it does, and visualize the crazy market as being all these jags up and down around this steady line, upward, always upward, I think, then you've got to say, I know I'm not smart enough to get out at the high. I know I'm not smart enough to get back in at the low. So I'm just going to stay the course, as we would say at Vanguard, and hang on through all that. And importantly, if I'm trying to accumulate money for retirement, or to buy a home, or to educate my children, what you want to do is keep investing. and say, how can I keep investing the day that the market goes down 600 points? That's the greatest time in the world to invest. It's certainly better than doing it the day before it goes down 600 points. And I think people have lost sight of the fact that a sharp market decline is, of course it's bad for sellers, but it's good.
It's very important, if you're looking for a margin of safety, to understand how to read a balance sheet, how to read footnotes, how to understand assumptions so you can get to recurring free cash flow. Enron, I mean, if you looked at their free cash flow when they were at the height of their game back in 2000, I mean, you could see that they were generating no free cash. And in fact, if you went into the proxy statement and you read page 99, because I'll never forget it, there was the chief financial officer disclosed, okay, that he was a general partner in partnerships, and it was disclosed, by the way, if you went and read and dug, and that he was a partner in partnerships that were in direct conflict with the company. That was a Hall of Fame disclosure.
Is it frustrating when the market goes straight up and up and up, as it did from 82 to 87? It was frustrating, and I worry, because just at those times, it's when the little guy gets sucked in, and the little guy finds it irresistible. When the market's going higher and higher, the little guy gets pulled in by stories from their neighbor, stories at the cocktail party, and they hear about how much money people are making in the market. Charlie, you probably know this, but the return from all mutual funds in the 1990s was 600 basis points higher than the average return from the investors in those funds during the same period. And that's because they get in at the wrong time and out at the wrong time. So that's painful to me.
So what is your lesson?
That's why I wrote the book, to try to educate the average person, but only like a few hundred of them read the book.
I mean, if you look at it like going to the races or something, that's a different thing. But if you're investing, I mean, investing is putting out money to be sure of getting more money back later, at an appropriate rate. And to do that, you have to understand what you're doing it in. I mean, you have to understand the business. And I like businesses I can understand. We'll start with that. That narrows it down about 90%. And I mean, there's all kinds of things I don't understand, but fortunately, there's enough I do understand. And you got this big, wide world out there. Almost every company's.
I tend to like stocks that are selling below book value. I also like stocks that are selling with very little debt. Debt gets a lot of people in trouble. All you have to see is these. The ATM machines where people run into huge amounts of debt, they can't pay it, they go bankrupt. I've been very concerned about borrowing money, and I think that's one of the things that people forget, that debt creates a lot of problems, and therefore you try to avoid debt as much as you can. And if you buy a company and you look at the balance sheet, and the other thing you should do besides looking at value line is get hold of their annual report. Read their report. See what the balance sheet shows. See what is the history of the company. And you might find that they're having problems, and the reason they're having problems is their product is not very good, in which case you probably wouldn't own it. But I do find that if you get a stock that's selling at considerably below book value, and it has a good history over the last 20 years, it gives you a certain amount of confidence in it, particularly if the debt is small, and if the management itself owns a fair amount.
So if you want to be a successful money manager, I argue here that you need two things: the right approach and then the ability to execute on that approach. So there are sort of 8 subcategories under each of those. Let me just very quickly run through them so we don't get too far behind. The right approach. First, when you're buying a stock, think about it like you're buying the whole company rather than trading a piece of paper or these days an electron. Secondly, you got to be able to tune out the market other than to take advantage of its occasional mistakes. The market is there to serve you, not to guide you. Thirdly, only buy a stock when it's on sale, margin of safety. Number 4, think first about avoiding losses and then think about how much money you can make, but think about protecting your downside first. Number 5, only invest when the odds are in your favor, then invest heavily. We've covered that. Number 6, don't spend a huge amount of time trying to figure out whether the Fed's going to cut interest rates by 25 bips next Fed meeting, what the dollar-yen trade, exchange rate's going to be, or even, although this is obviously has an impact on many of the stocks we own, trying to predict, when exactly our economy, the recession that we're in, is going to end and when things are going to turn up and so forth. Even though it's important, it's very difficult for it to be knowable. And you need to spend your time focusing on things that are both important and at least somewhat knowable. Number 7 is be flexible. Try and expand your circle of competence and don't limit yourself to just investing in small caps or just investing in the United States if you have expertise in other countries, just investing in certain industries. The corollary to that is you always want to make sure you're well within your circle of competence, but within that...
I think one of the central things I learned from being a guinea pig in these experiments that I couldn't have learned in any other way is the difference between expectation and experience. The human brain, it turns out, is designed to expect events much more intensely than we actually experience them. You hope to make money. That's what we call greed. Greed is an intensely powerful experience. But actually making money rarely feels as good as hoping you will make it feels. Likewise, losing money is something we dread when we think about it in the future, even more than we experience when it actually occurs to us. We're all actually more afraid of losing money than we probably should be, because it feels terrible, but it never feels quite as bad as you think it will if you're expecting it.
Hurting is a response to having not enough information and thinking that others around us can actually give us a shortcut to how to make a decision.
Dr. Richard Peterson is a psychiatrist who now manages hedge funds. He says the impulse to stick with the group dates back to our earliest ancestors.
If we're in a group of people on the Serengeti and one person starts running, we probably either want to pay attention to what they're running away from or start running with them, because those who didn't do so would be a meal for the lion.
Today, lions are less of a problem, but the desire to be part of a group is still...
All the MBAs who are taught to do discounted cash flows, or what is a shorthand for that, ratio, or multiple valuations, have been taught what may be a proper thing in theory, but is for 3 basic reasons a terrible way to value securities in practice. And the first and most fundamental is that when you do a discounted cash flow, you take weighted averages of near-term cash flows, which are projections, which are very good information, and distant cash flow projections, which is very bad information, and you add it together. And when you add bad information to good information, you wind up with bad information. Secondly, they ignore balance sheets. It's all projected earnings and multiples of earnings. And balance sheets are the most reliable, solid information you have about a company. And the third thing is that if you look at the assumptions that go into a discounted cash flow model, they are profit margins, growth rates far out into the future, costs of capital. Nobody knows what those are for a company like Ford. But there are things you do know about Ford. Is this company going to be economically viable? Probably not.
And we talked a little bit indexing over lunch. I don't believe in indexing. I don't believe it at all. Indexing, in my view, is a cop-out. Why do people index, or why do institutions? They index because they want to be close to some index number. It'll keep them from being fired, and it breeds mediocrity. If we're all going to index, if we're all going to manage big pension fund money and indexing to an index, we're all going to get the same performance. We're all going to look like heroes. If that was the case, what do you need your MBA for? What do you need your CFA? What do you need Mr. Buffett? Mr. Buffett doesn't index, and I'm sure Ben Graham never did. In fact, if indexing is so good, you don't have to hire a fancy, talented management. My 8-year-old daughter can do that. Because all it is, you just plug in a few, tick, 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 and you're there. So I have definite views on that. I do believe the market is imperfect. If you do your homework, and you do need the patience of Job. You buy something, it doesn't happen right away. A lot of people will buy a security at $10, and it closes the day at $9.90. you're off 10 cents. And people flip out. I'm sorry, life doesn't work that way. You know, sometimes it rains. Sometimes it snows. You have to have the courage of your convictions.
Second underlying principle that we think about is the world is oriented towards relative performance. It's one of the giant weaknesses in the investment world. All the big mutual funds are focused on competing against each other, competing against the market. So they're looking at relative numbers. If the market's up 20, they want to be up 21. If the market's down 20, they want to be down 19. The reason for that, by and large, is everybody's an asset gatherer. And when you gather assets, if you perform in the top half of performance, or if you avoid the bottom quartile of performance, you almost certainly never get fired, you don't lose clients, and your firm is very profitable and successful. So, by contrast, we think wealthy individuals and established institutions, because of the risk aversion, are actually interested in absolute returns. That in other words, if you're focused on absolute returns, the idea of losing people's money becomes fairly abhorrent. And if you focus on relative returns, you're happy with losses as long as you lose less than everybody else. So the relative approach ends up forcing people into a kind of a closet indexing approach, that you don't want to look very far away from the indexes. You don't want to look very different from the indexes, because if you underperform by taking a chance at being different, you could lose a lot of your assets under management. So you end up kind of tracking the indexes and lying very close to them, which basically gives you insured mediocrity, that you won't severely underperform, but you won't outperform either. Our view is that the idea of sending a letter to a client, dear client, the markets were down 30%, we were down 28%, would make us sick. That your goal is not to lose less. Your goal is to kind of try to make money all the time, protect capital on the downside, and still do well enough on the upside.
So the wonderful business, you can figure out what will happen. You can't figure out when it will happen. You don't want to focus too much on when. You want to focus on what. If you're right about what, you don't have to worry about when very much. Question about what's going to happen to interest rates or where we go in the world. I don't think about the macro stuff. I just the important. What you really want to do in investments is figure out what's important and knowable. If it's unimportant or unknowable, you forget about it. What you talk about is important, but in my view, it's not knowable. Understanding Coca-Cola is knowable, or Wrigley, or Eastman Kodak, or anything. I mean, you can understand those businesses. That's knowable. And whether it turns out to be important depends on where your valuation leads you and the current price and all of that. But we have never either bought a business or not bought a business because of any macro feeling of any kind. We don't read things about predictions about interest rates or business or anything like that because it doesn't make any difference. I mean, let's say in 1972 when we bought See's Candy, I think maybe Nixon put on the price controls a little bit later. Let's say we'd seen that. But so what? We'd have missed a chance to buy something for $25 million that's earning $60 million pre-tax now. I mean, we don't want to pass up the chance to do something intelligent because of some prediction about something that we're no good at anyway. So we just don't read or listen to or do anything in relation to macro factors at all. Zero. And the typical investment counseling organization goes out and they bring out their economist, they trot him out, and he gives you this big macro picture, and then they start working from there on down. In our view, that's nonsense. And if Alan Greenspan was on one side of me and Bob Rubin on the other side, they were both whispering in my ear exactly what they're going to do the next 12 months. It wouldn't make any difference to me in what I pay for executive jet or general reinsurance or anything else.
And find an active manager that they feel comfortable with. That makes a lot of sense. If they have the ability to actually do analytical work, there's companies, by Procter & Gamble, you're going to be fine. I mean, you probably own Procter. And, yields 3%, 3.5%, 4%. But I think this is a time where I think you can create a lot of value for yourself if you have the patience and the fortitude.
Patience and fortitude. So we'll leave it there. David Wintersman and Irving Fund, great to have you on Wealth Track. And Chris Davis, it's lovely to have the two of you together from the Davis Funds. Thank you so much for being with us on Wealth Track.
Thanks,
At the conclusion of every Wealth Track, we try to give you one piece of advice to help you build and protect your wealth over the long term. This week's action point is avoid what guest Chris Davis calls the investor behavior penalty. Now, historically, individual investors have failed miserably at timing the market and have been penalized as a result. Over the last 20 years, for instance, the average stock investor has both underperformed the market and stock mutual fund returns by substantial margins. The reason? They tend to buy when everyone is optimistic and stock prices are rallying, and sell when pessimism prevails and stock prices are falling. Buy high and sell.
Somebody asked me if we're in a good or bad market. For every person who wants to know if Goodyear Tire is a solid or attractively priced company, 4 more want to know if the bull is alive and kicking. I always tell them the only thing I know about predicting markets is that each time I'm promoted, the market goes down. As soon as those words are launched from my lips, somebody else asks me when I'm due for another promotion. Obviously, you don't have to predict the stock market to make money in stocks. I've sat at my Quotron through some of the worst drops, and I couldn't have foreseen them if my life depended on it. In the middle of the summer of 1987, I didn't warn anybody, least of all myself, about the imminent 1,000-point decline. I learned in graduate school that the market goes up 9% a year. Since then, it's never gone up 9% in a year. I've yet to find a reliable source to tell me how much it will go up or down. Another theory is that we have recessions every 5 years. It hasn't happened. I've looked in the Constitution, and nowhere is it written that every 5th year we must have recession. I'd love to know when we're going into recession. Unfortunately, when Future Man comes to Boston, I'm always on the road. I'd be able to adjust my portfolio. Things are never clear until it's too late. We always seem to be preparing ourselves for the last thing that's happened. This penultimate preparedness is our way of making up for the fact we didn't see the last thing coming along in the first place. People began to worry the market was going to crash the day after the market crashed on October 19, 1987. It had crashed. We survived it, and now we were petrified there'd be a replay. Those who got out of the market to ensure they wouldn't be fooled the next time were fooled again as the market went up. I don't believe in predicting markets. I believe in buying great companies, especially undervalued or underappreciated companies. It doesn't matter where the Dow Jones Industrials average is. The market ought to be irrelevant. If I could convince you of this one thing, I feel this tape has done its job. I'd love to be able to predict markets and anticipate recessions. Since that's impossible, I'm satisfied to search out profitable companies. I've made money in lousy markets and lost money in great markets. Pick the right stocks and the market will take care of itself.